Please welcome the panel on Capital Markets 2025, Shaping and Scaling the Future, moderated by Shonali Basak, Global Finance Correspondent at Bloomberg.
Today, and it's great to be with all of you and a very interesting moment in markets. Capital markets is what we're here to talk about at the moment. And we have a lot of different perspectives to get through, so we thank you all for joining. Seema, let's just get started with you. Let's just get the 1,000-foot view from an investor's perspective. When you're taking a look at the capital markets today, I should say, when we planned for this panel, we said we're not going to just talk about what's happening moment to moment, day to day. We're going to take the longer term view, the bigger picture. What is the bigger picture and how you invest through this tumult?
Yeah, sure. So I think it's important to, well, I've got 3 or 4 points, if you let me. The first thing is to say, look, I don't think anyone here wants to talk about the macro that's happening in a way, because we've heard about it over and over again in the last day or so. But at the same time, it's important that we remember that, a lot of strategic direction has been swayed over the years by really seismic current events. So it's, we don't want to completely dismiss what's happening. I think that a lot of what's happening today has been driven, it's almost born from COVID. We want to forget about COVID, no one really talks about it. But when you think about the fact that a lot of what happened then was transferring from government over to corporates and households, and you've seen this big blow up in government debt, which to me is one of the reasons why the Trump administration is moving in the direction that it is. So, if you believe what we heard from the Treasury Secretary yesterday, where he talked about their 3 policies are all interrelated. Tariffs are there to raise revenue, to hopefully offset some of the tax cuts that they want to bring in. Deregulation is there to increase growth and ideally grow their way out of some of the debt problems that they have. So a lot of this is born from that. And do I think that we are going to see a continuation of concerns around government debt, which is going to lead to a number of harebrained ideas from governments over the next decade or so? Absolutely. So market volatility and policy volatility is probably going to be here to stay. And then the second thing is when I think back to the beginning of this year, our overriding perspective before we heard about tariffs was that it's really, really hard to get recession in the US and globally, but mainly in the US. Because, again, from COVID, you see this transfer, corporate balance sheets, household balance sheets, really strong. And that resilience means that it's tough to get an economic downturn, a meaningful economic downturn. You need to have everything go wrong. And at the same time, what we've learned in the last couple of years is that policymakers really want to step in and help with even the smallest sign of concerns. And so what Scott Bessent was saying yesterday with regards to deregulation and tax cuts, I think that is a step in from the Trump administration saying that, look, if we are heading in a slightly wrong direction, then we need to step in. And so from our perspective, we're not expecting recession. A slowdown is likely to happen. But the business cycle, to me, is almost completely dead. And if you're an investor, it's important to remember that, because actually that means that if the business cycle is dead, you're not likely to see a return of the post-GFC style very strong returns in risk assets. So over the next 10 years, low returns, high volatility, which is going to mean an increased interest in looking to private markets, global diversification, as investors continue to seek any opportunity that they can to make something similar to what they had in the last 10 years.
So that's the big picture view. You mentioned volatility, and I've got to say taxes, deregulation, and tariffs are the 3 words we probably hear the most these days at Bloomberg News and Bloomberg Television. Jim Esposito, Citadel Securities, volatility is something you all know well there today. How are investors navigating through the volatility, especially if what Seema says is true, that it might be a more prolonged phenomenon? How do they manage it?
Look, with a little bit of a historical perspective, what I've observed during this recent volatile period, it really is a stark contrast to prior periods where we had material dislocations in markets, whether that was 1998, obviously the global financial crisis in 2008, the period around the global pandemic. I think we have to give policymakers and regulators a lot of credit for the actions they took after the financial crisis I can't recall a time in my career where we saw volatility spike, asset prices fall materially, and really not get any headlines, any rumors, any actual results where somebody was going out of business, somebody was suffering. It was one of the more orderly material market sell-offs that I've been a part of in my career. So I think that's noteworthy, and I think regulators and policymakers deserve a heck of a lot of credit for that. The other thing that I would say is in our business, while I don't wish a difficult, challenging market environment on anyone, you give Citadel Securities a period of high volumes combined with high volatility. It allowed us, I think, to distinguish ourselves serving our clients. And so our market shares tend to go up in these periods where, as a technology-driven first market maker, the reliability and durability of one's platform really steps to the center. And that's been a really interesting time for us serving our clients globally.
So let's hold that thought over there on the idea of orderly markets. So we'll have a lot of questions on that. But Jeff, let's talk about a point that you made as we were preparing for this panel. The standard way we've looked at markets post-World War II is not going to be the way we look at them moving forward, is what you said. And so that's a large setup. It's a long-term setup. What do you mean by that?
Well, I think, so we just look at the world order. Everything we've experienced and everything our parents really experienced comes off the back of the Second World War, at least in the Western world. And the frameworks for how geopolitics set up, the investing framework, let's remember that in this country, the Securities and Exchange Act of 1933 is right before the Second World War. So when you look at this explosion and you know, America's growth as an economic power is off the back of the post-World War II world order. The further away we get from the Second World War, the less relevant that is, and new things happen. And I think what we're seeing now, certainly with the emergence of China and the dominance of things like AI that are massively disruptive, that some of the standards to which we become accustomed are no longer going to be standards. So how long can the U.S. continue to deficit spend? You know, as we can do it for a while. Certainly, as the world's reserve currency, we can do it. That's another thing that happened after the Second World War, which is the dollar became the U.S. world's reserve currency. I hope that continues for the next 100 years. But one of the things that we need to think about is what would need to be true in order for that to extend for the next 100 years. And I think one of the things people are having a difficult time with in this administration, because you get all the noise that comes along with it, is there's a fundamental understanding that trade imbalance does not is sort of table stakes, or getting trade better balanced is table stakes to perpetuating U.S. supremacy, at least dollar supremacy, for the next century. How we get there, the way we get there, the rhetoric that's come around, that goes around, will absolutely be increased volatility, and certainly we've seen that. But when people get their heads around the fact that this is a necessary ingredient to maintaining America's supremacy as the leading capital market, markets will figure it out pretty quickly. And they'll price that in, even though there's likely to be more volatility along the way. That's kind of where our heads are and what we're helping our clients to think about as they navigate. You shouldn't just take what you know and what you've experienced in your entire career and assume that it's going to be that way. In fact, we start from the standpoint that it won't be that way. And then you go from there.
It's interesting because yesterday, Vis, I spoke to your colleague Jane Fraser, of course, the CEO of Citigroup, and she had mentioned she's keeping her eye on that dollar pretty closely and how it's behaving right now. How are your clients? Citigroup is the most global of the U.S. banks. How are your clients reacting to the changes being made in the U.S. with its trading partners? Are they viewing the value of U.S. assets differently?
So, good day, everyone. Great to be here. I would say, you know, right now it's a hiatus, wait and see. So most folks are, you know, you don't know how this tariff thing is going to land. There's no knee-jerk reaction, so we're not seeing revolvers drawn, and, you know, there's no panic. You know, everyone is kind of approaching it in a very kind of a calm, you know, methodical way. But underneath, there is clearly a lot of apprehension, and the mindset, and we polled quite a few of our clients in countries around the world, you know, from a trade finance perspective, supply chain finance, from corporate banking. And the mood very much is if tariffs are digestible, so if you end up at 10%, 15%, there is a pain threshold where the mindset is, you know what, we can absorb it, we'll soak it, we'll figure it out within our kind of cost of goods sold, and then we kind of continue operating as we are. And the question there is, does that make in America happen if it's clearly there'll be tariff tax takings, but in terms of absorbing those costs, that friction is kind of, soaked up within those countries. The question then is, what if tariffs settle for, if that break-even cost is much higher, then the question is, okay, we have to revisit, we got to rejig supply chains, and we got to kind of figure out how we navigate, this kind of new dynamic. To Jim's point, I think the one thing which, we talked about markets down, long bond up, we seeing volatility and dollar weakness, but the one thing which kind of really has surprised a lot of observers is gold. So despite all of these other assets, kind of in a contrarian way, gold is lingered around 3,500 or thereabouts, and I suppose therein lies that defensiveness, that apprehension, and that tentativeness around what asset class do you pile onto. And the last point, as clients look at the dollar, its status as a reserve currency, the question is what is the risk premium now? Because that risk premium has changed. There are two deficits. One is clearly the trade deficit, which I may be an outlier, but I think I'm more bullish that you land somewhere. It may not be acceptable to everyone, but I think you'll figure something out. And the other one is the trust deficit, which is you had a stable, very predictable kind of a reserve status, for everything, for dollar, capital markets, and all the rest of the stuff. That will, depending on how these next 90 days or whatever is left and how the rest of this year pans out, you will see an element of, if there's clarity, then people will just shrug the events off and go. But if there is a lot more melodrama and the like, then the question is going to be around, okay, what does it mean for the risk premium for assets in general?
If I could just amplify on one of Vis's points, the question we kept getting asked in the days that followed the administration's tariff announcement is, are we actually seeing a change in behavior by global investors? And so at Citadel Securities, we have a very prominent market share in trading of U.S. cash treasuries. So the question that kept coming through is, are you seeing sovereign wealth funds, central banks selling U.S. treasuries? That really was the fundamental question that was on people's minds. The answer to that was we weren't. And so I think there was some long-term behavior demonstrated by investors around this American supremacy point. There might have been some erosion around the edges, but people weren't throwing in the towel, over a 50, 100-year period. They were demonstrating a level of patience, wanting more information, allowing themselves to see how this plays out before they were voting with their feet.
Yeah, I just want to echo that because we saw something similar. Although the day that they had the 3-year auction, direct participation was down meaningfully, and it tailed. And 3-year auctions, for those of you who don't know, it's a yawner. I mean, it happens all the time. Most of us never talk about it, but the markets sort of started to read through that there was a lack of buying and demand. And the reality is, it just was less participation on a direct basis. But it was a wake-up call. Because as much as there is a strategy, and I think you articulated it really well, Seema, around, that's a coordinated strategy that the Treasury Secretary has articulated, there's a lot of volatility around whether that strategy gets executed. And the biggest was, are you going to knock the dollar down to a place where it's a longer and more sustained erosion of trust? And we're not there yet. I think there was a lot of people that went on TV in a lot of places and a lot of lobbying into the administration to make sure that doesn't happen. But if it goes on for an extended period of time, I think there'll be a natural inclination on the part of other nations to build other reserves around the U.S. dollar that chip away at dollar supremacy. So it doesn't happen overnight, but that's in the conversation now. And I would say prior to, Liberation Day, that really wasn't in the conversation. And so it just depends on how this plays out over the next 3-4 months.
And so, sorry, Sima's point on kind of perspective on Asia is going to be really important. But I was in Germany a week and a half ago at a real estate conference, and the overriding sense is not necessarily losing confidence completely in the US, but because the moves from the US have invigorated a lot of policy stimulus, movements from other governments to think about reshoring their economies and foundations, and of course because of the currency dynamic, there is a new sense of optimism. It may well end up being disappointed, but there is a new sense of optimism around European investors for their own domestic markets.
Yeah, we'll get to that as well, but we do have a massive foreign investor here as well, the head of the Singapore office at Norges Bank Investment Management. I mean, how do you look at this issue from where you sit? It's quite the seat.
Well, from where we sit, well, first let's start with the Asian perspective, if you will, sitting in Singapore. I mean, Asia wants to talk. Asia wants to have some understanding of where things are going to go, some sort of roadmap, and then the markets will adjust. So the real issue right now is the uncertainty, and everyone knows that. What I would tell you, though, is that the region continues to develop and create trading networks amongst themselves. So even outside of the headlines, everything that we're reading, you look at Singapore expanding its relations with its neighbors. You look at ASEAN as a whole, I think in the next year or two might become the 4th largest trading bloc, if you will. You look at what India calls West Asia, or the Middle East, as other people call it. Look at it increasing the sort of trading relationships they have with the region. So Asia continues to integrate, it continues to trade. It's just the uncertainty and the overhang that we are waiting for some sort of resolution for. What I would also tell you is, you say, yes, we are a foreign investor, I agree with that, but half of our assets are here in the United States. We have had a fantastic experience with the companies here, getting to know them, learning from them. Very hard to see that changing. It is a tremendous ecosystem right here. So as we see it as a very long-term investor, we are positioned to take advantage of the volatility. We have a mandate, very broad-based, consensus-driven mandate that allows us to do that. And so in times of dislocation, we are and should continue to take advantage of the companies that we like, people who we know, and continue to invest that sort of capital for the long term. Of course, it's very challenging in any of these short-term periods of dislocation. But as has been said before at this conference, we have been here before. We have been through multiple periods that have looked far more challenging and have emerged much stronger. And let's just say you were not reading the headlines and you had come here and you listened to the dynamism, the innovation, the sort of intellectual firepower, even in this fantastic conference, you would leave with a very positive view of the future.
Can you confidently say in 10 years the mix will still be 50% of your assets in the United States?
No, I can't say that with confidence. But what I can tell you is that while the rest of the world is growing, so yes, of course, I'm sure we will have more in Asia, and I suspect we will have more in Europe as Europe continues to focus on its priorities. The innovation and the kind of ecosystem you have in the US is still second to none. I would be very surprised if it looked much different, but 10 years is a long time.
Jeff, it's interesting. You now work for a Canadian bank.
I do.
I was wondering if you were watching the White House today.
Of course. Okay. But even if I weren't working at a Canadian bank, I'd be looking at what's happening in the White House.
I mean, how important is the North American alliance?
It is important. I mean, I didn't vote, obviously, in Canada, but I'm glad to see Mark Carney. Many of you, if you've been coming to this conference for a while, know that he was a fixture here for a long time, and he is incredibly thoughtful, rational, balanced, and also, like, he knows what he's doing. And I've been saying to a lot of our Canadian colleagues and clients, we don't know what the U.S., up until the time they have their first meeting, which is today, we don't actually know what the new stasis is going to be. All we're doing is just listening to the rhetoric. And everything is it's like teeing up this negotiation, and people are trying to figure out how to create leverage. The president does that, through his rhetoric. So we'll see. What I will say is I don't think I fully understood or I appreciated the degree to which the interdependence is so critical. And it really is. And I'm not sure, by the way, given some of the early rhetoric, that there was actually full appreciation of that from the administration, but now there is. When you get down, and the people I've talked to who are dealing with complex supply chains where goods flow freely back and forth over the border, it's not a one-size-fits-all solution. There'll be some puts and takes. There's some natural places where Canada's going to want something, the U.S. is going to want some things. So there's some natural places where we can go, and we'll see. But to think that that relationship is permanently fractured, that would be an oversimplification. I think you'd be wrong to think that. So, I'm not in the room for those discussions, but I can just look at the situation as there's a lot of mutuality to working out whatever the new order is going to be. I do think bilateral negotiations is part of what this administration, the Trump administration, wants. And so people should be getting in there to do their bilateral negotiations, get what they want. Probably the United States has said we're open for business. We just want to do it on a one-to-one basis. So I'm more confident that they'll figure out what the new go-forward looks like because there's too much to lose if we don't.
It's interesting. As the negotiations play out in front of us day by day, the markets in recent days have been relatively calm based on what we've seen this year. I want to go to you on the capital markets, kind of in the truest sense of the word. You've seen moments in the last month or so where we have seen certain parts of the capital markets seize up. And it leads me to wonder how much pain that is causing underneath the surface, given that it makes it difficult for companies to tap capital.
So I would say right now it's all fluid. It's all working. Liquidity is available. No panic, no distress, so you're not seeing a flurry of rights issues and preemptive capital increases or drawdowns, as I said. You are seeing corporate finance activity. So even in the last 90 days or so, you've seen a flurry of announcements. Many folks in this room, the PE community have been big kind of players in that activity. You saw kind of, we did the Boeing sell side of Jefferson, and that was a fantastic, fantastic receptivity to that transaction. So you are seeing the quality assets are getting very, very good reception. Though with M&A, you have a bit of a lag effect because, the transactions that, were cooking in the quarter gone typically kind of show up now. But what you are seeing is reticence, where we've seen transactions being pulled or being paused because boards are unsure about launching a deal in this environment. The IPO market is a totally different story. I mean, this was, at Davos, we heralded, the animal spirits and, the return of the IPO market. That's kind of on pause. And there, it's not a demand thing alone. So, folks often say, oh, the money's going to be back and people will start buying IPOs. It's a bit beyond that because the investment thesis and the equity story needs to be re-articulated around what do all of this mean for my capital structure, my cost of goods sold, what is the friction cost, where am I going to make, what do my supply chains look like. And unless you have more clarity, companies are not going to be sitting there selling an investment thesis or an equity story because they don't have the clarity. It's the same as, if you look at all the results guidance. And every company that has guided has put bookends, to say, if it was benign, it will look like this. If it's really bad, then it could get worse. So the IPO market is going to be sluggish for reasons more than just demand. It's going to be, and then on the debt side, a lot of high-grade debt got refinanced last year. I mean, you saw a torrent of high-grade issuance. An element of that will kind of trickle through, the best names get done. And on the high yield side, it's really going to be acquisition financing and refis. And there it's really, once again, flight to quality. So no signs of alarm in any kind of way. It's pause and see. And there's no panic.
I saw you piping in there, Jim, but I also want to ask you, from the seat of a massive market maker, are the animal spirits completely dead?
Say it again.
Are the animal spirits dead? Are they gone?
Yeah, so I just wanted to pick up the point on the IPO market, having spent a large part of my career around the capital markets, helping company raise both equity and debt capital, now being at a large size market maker without an underwriting business. Perhaps I can speak with some clarity on the topic. And I do wonder, and I'm not sure I can prove or demonstrate this, but this was sort of going in this direction. If something structural has played out over the last decade that simply makes it harder for medium and small size companies to go public. And so I think some of that might be attributed to just the significant amount of money that moved out of active equity management into passive. You think about the advent of basket trading, factor trading, obviously the whole ETF ecosystem. ETFs don't purchase IPOs. And so I think something fundamentally, structurally may have changed. That doesn't mean companies can't go public anymore. Certainly large-size companies have tremendous access to public capital, but we keep waiting. It's another quarter. We need more confidence in the markets. I don't think people talk enough about the underlying structure. There's just less portfolios out there willing to put a price on new companies between $5 and $10 billion in size, and I think that's a really important consideration. On your point around animal spirits, look, I think, again, the good news that I was alluding to earlier, there's been some drawdowns, but we've avoided major dislocations. In a world where there was an attempt to completely rewire the entirety of global trade flows, it's hard for anybody to have animal spirits until they know where we're going to stick the landing around that. You know, we heard it already from a large investor. I think people are looking to play offense. I think there is still ample liquidity and capital that's going to find its way into markets as soon as we have more clarity. My only distinction here is I'm not sure that means the IPO market opens so easily.
Seema, if you want to... Oh, Seema, please.
Well, I was just going to say to your point, obviously we want companies to list, and we want them to list early. This is our space. But we really need the cooperation of the entire ecosystem. There's no silver bullet for this. It's not... Of course, we'd like founders to accept a more diversified shareholder base. We would like to see exchanges. We're already seeing it, but exchanges that can perhaps ease some of their listing requirements. I think NASDAQ's doing a very good job, but even in Asia, we're seeing that Singapore, Hong Kong, et cetera, are all trying to find a separate grouping, if you will, for some up-and-coming companies. They can maybe ease some of their listing requirements. So, well, maybe the investment banks can ease the IPO process with charging less fees, perhaps. Who knows? But either way, it's all of us coming together to this ecosystem that encourages companies to list early. So hopefully this happens, because what we are finding is there's no shortage of really great companies that are choosing to stay private, and we would like to see them list.
So, Jeff, would you like to fix the problem?
On that, I think, so first of all, we tried to address this with the Jobs Act in 2012. It's hard to believe it's 13 years. And we did. We changed some real structures. Some of you were involved in that and in the lobbying efforts and in the drafting efforts when we put that together. And it did change. And I've said here at this conference many times publicly, if we hadn't done the Jobs Act, there'd be no vaccine, right? Because Moderna and BioNTech both used the U.S. capital markets, and they were both emerging growth companies under the definition of the Jobs Act that allowed for them to get both private capital and public capital as smaller companies. So there is a real tangible benefit to enabling that. The structural problem, though, Jim, I think is that asset managers, yes, passive and active for sure, but asset managers are just very big, like super big, way bigger than at any other time in our history. So when you think about bringing a $50 million IPO, right, if that $50 million IPO triples over the next 3 years, that would be a home run from a return standpoint. But for the aggregate dollars return, very small. So it's really hard to get the attention of large people who manage large pools of capital for small companies. That's actually the biggest impediment more than anything else. We've spent a lot of time on market structure and all these onboarding, but the reality is it's just hard for small companies to garner any attention. And I'm not sure what changes that other than building an ecosystem of smaller investors or thinking about how asset aggregators think about smaller funds that allow for more participation from more people. I don't know, but it seems to be more of a market conventional structure than it is sort of a regulatory framework. I'll also say this, I think we're having a very rational conversation here, which is great, right? And it's hard to have rational conversations trying to figure out what this administration is going to do without seeming like a shill for the organization, for the administration. And I think a lot of people that know me know that I'm probably anything but that. But the reality is we have to put aside whatever our proclivities are to understand what might be true about the strategy and allow for us to be able to make rational decisions outside of the rancor. And I think that's a really important thing that we're doing here, and I appreciate you do that pretty well in your reporting, actually, and it's helpful. That's really what we're doing here. It's one of the few places we can do it without feeling like you're under attack from either fringe.
So Natalie, just one point on IPOs. They're also very existential because there was this debate around private markets overshadowing public markets. If you look at the 401k and the access to the man on the street to partake in kind of the economic wealth or the economic wealth of capital markets, IPOs are really the main medium, or secondary equities the main medium, because not everyone is able to get into private equity. It's a bit more elitist, it's bigger ticket sizes. So for that wealth sharing to happen, you need healthy public companies, coming into the system, because that is how especially within 401ks, et cetera, the broader population can partake in wealth creation. So.
And it's interesting. The issue of the IPO markets is one we've covered a long time, and you have to wonder with this environment that we're in if the smaller companies might even have a harder time, given that they have not seen as much love as the larger ones. But I do want to get your opinion here, Seema, on Europe on this front, because a lot of investors are looking at Europe and saying, look at the Draghi report. They are saying this might be the moment here to create maybe multinational giants, if not at least larger companies that might be attractive for investors. How do you feel about it, and are you taking actually some of those dollars away from the US into Europe?
Yeah, so it's funny because you mentioned the Draghi report. When that came out, I think everyone acknowledged that it was wonderful, a lot of important insights, but it was pretty much shelved immediately because what he was asking for was deregulation, which has been something which is continuously dismissed in Europe. And as a result of that, investors have typically said, look, Europe is a perennial disappointment. It does well for 3 months or so, and then it goes nowhere. You are actually seeing a shift in perspectives, and US investors aside, actually for the first time, portfolio managers are saying, well, look, actually maybe there is something to be shown in Europe. As I said, I was in Germany a few weeks ago, and the general narrative there was not necessarily, again, that they've lost confidence in the US. It's not, a consideration of market dysfunction or the dollar is going to disappear. But it was almost like, well, look, what we're seeing in Europe is this growing acceptance that fiscal austerity has not been the right path. There is a lot of opportunity there, but there hasn't been that much innovation because of regulation. And so for the first time that I can remember, European governments, and particularly Germany, is actually talking about deregulation. And in February, after the bill was passed in Germany, I was in Madrid, and those investors there were very skeptical at that point of the bill. They said the real game changer is if you start to see the market opening up, and you're finally seeing that in the last couple of weeks. So what we're seeing is that investors, again, they're not saying let's shift away from the US, but if there's a marginal dollar, it really is a discussion of, okay, what is the global opportunity set? And Europe is coming to the forefront. Now, this morning's news on Germany, where the loss of vote, that's again one of those moments where you think, oh God, is Europe going to disappoint once again? I would hopefully have some optimism that maybe this year is going to be challenging, but if you're looking at over a 5-year period, it's certainly a more interesting prospect than it was.
Jim, it's interesting. You're building your business around the world. It's an interesting time to be doing that. What locations are you looking at that have the most promise?
Yeah, you're right. Our business has grown a lot over the past couple of years. We're still too skewed towards the U.S. We're a bit more skewed to equities than fixed income. So the two big strategic priorities of ours is getting bigger and trading more products in fixed income, and then expanding outside of the U.S. And so more specifically, we are seeing incredible opportunities in Asia right now. Bloomberg had a story that Citadel Securities was applying for a local market broker-dealer license in China. So we're still believers. There is a big, important strategic market for us to be involved in China. We're seeing opportunities doing what we do so well, which is helping retail investors execute their transactions and find liquidity. India has become a very important market for us. We're getting bigger in Japan as we speak. And so specific large countries with liquid capital markets is a place where you're going to see us be more prominent. I think Europe is very much on our radar screen. You know, there's a ADR, ETF type ecosystem that's getting bigger in Europe that should fit our skills and experiences. And so outside of the US is a place I think you'll see Citadel Securities, you know, continuing over the next 1 to 3 years, get a lot more strategic and a lot larger.
Well, that's a really good space for Sumer to weigh in as well. What are the areas you mentioned that there was more opportunity growing? If you had to choose 1 or 2 areas, what would they be?
Look, it's definitely India. We've recently taken a trip there, meeting various companies, getting a sense of the ecosystem. I think you really do have to focus on national interest. You mentioned the Draghi report. In the case of India, there is a clear mandate from the top to cut the red tape, ease the bureaucracy, really focus on the next 10, 15 years. Foreign policy is obviously becoming not only more assertive, but at the same time, foreign policy there is now looking at what suits the economy. And this is something that you hadn't seen before. There are some great companies there. We've met tremendous leaders. There was a very, if I may say so, they were not only super business people, but there was a real human side of management that all of us noticed. It was quite different from what we had seen before. Companies whose leaders had not come from the previous, English-speaking elite, if you will, from a certain core group of top universities. We saw a much more diverse group of new companies coming, universities that we hadn't heard of, people where English was their second language, a different group of leaders. Very, very interesting. So I would say we are quite positive there.
Can I ask a question to you? Because what we've seen in the last couple of years is that India's performance has been directly related to China's struggles. So are you, with your perspective that, our portfolios as well, India has been a favorite, it continues to be a favorite, particularly now that it seems like it's at the front of the queue for any trade deal. But your focus in India, does that mean that you have concerns about China's outlook as well?
No, what I would say is that your point is absolutely right, but what's happened with China has caused everyone to get their house in order. It's not simply just an Indian perspective. Now, we met someone in India who said, thank goodness for the fact that there may be some issues with investor perception towards China because we are the beneficiary of that. We get that. But at the same time, Europe, parts of the United States, everyone is now getting their act together and saying, okay, what is our national interest? What do we need to focus on? So, yes, of course, India is a beneficiary of the China +1, as are other countries in the region. But even aside from that, I think the country itself is now maturing beyond the post-colonial sort of view to bring in a totally new set of business people who are focusing internally on their own markets, ignoring the consequences or the yoke of history, if you will. Having the China +1 is a tailwind, but even without it, I think the trajectory is quite clear.
And if I can add to that, because one of the things that we've seen is that investors recently have been very worried about India's valuations. Right? They look at it and they say, historically, it's rarely been more expensive than it is today. But actually, like you said, the Indian economy today is a completely different beast to what it was 20 years ago. So even that comparison to historical valuations, to me, doesn't actually measure. So you do have to look at the next 5-10 years and how it's moving. And as you said, the reforms, the bureaucracy, the new innovation, the knowledge capital has been very interesting.
Well, one thing I have to say, since we've mentioned China, and I would say we are obviously investors there, and they have a lot of tremendous companies, but you have to know that the impossible can become the inevitable very quickly, especially in our business. So I would certainly not lose focus to comments made there in favor of private enterprise. All it would take is, I'd say the threshold is quite low, a few kind words, a few tweets, a few handshakes, and I think you will find a tremendous amount of capital is once again redirected towards China as well. So there is a lot of money, I would say, waiting to go and continues to look at Asia.
Yeah, so I would say, just listening to this and some of the things that I've heard from companies, there's going to be a tremendous amount of capital raised and spent for reshoring. We talk about it in the United States from a very U.S.-centric point of view because, we're shouting from the rooftops. We need to make more stuff here, right? Everybody's going to make more stuff in their. And if you're an emerging economy, you're thinking about, lessons learned from globalism. I can't outsource fill in the blank. Like, what is my real role in the comparative economics game, right? I don't think there's anybody here that actually thinks it was a great idea to cede all of the semiconductor manufacturing to Asia in the United States. And if the United States had to do it over again with an industrial policy, it wouldn't, right? So the United States is reversing some of the mistakes, or trying to reverse some of the mistakes that were made from a lack of a coherent or cohesive industrial policy. The emerging economies actually have the benefit of thinking about how they'd like to set that up. Either way, the amount of money that's going to be raised in each of these places is going to be enormous because there'll have to be a build-out. And capital can move now more easily in more places than ever before. Jim, if you're building around the world, it's an acknowledgement that we can create liquid markets anywhere in the world, and that has a huge implication for us in the U.S. from a regulatory standpoint.
Well, I feel like
right?
you would have a great view on this because your clients are operating in countries all over the world, sometimes cross-border, but sometimes doing that nearshoring process. How much is that happening, and how big is the rethink? We started talking about COVID and how that started the process. To what extent is the current trade war fueling that process?
I don't think it's fueling it right now. I think it is wait and see. But you saw after COVID, the whole notion of nearshoring and friendshoring came up, and now clearly nearshoring has proved moot. You don't know who friend is anymore, or otherwise, And so the question really is, companies have drawn backup plans of what Make in America looks like. How do you rejig supply chains? But as I said earlier, I think the main focus right now is what is the tariff friction likely to be, and how easily can I absorb it within my current my cost structure, and how much can I absorb, how much can I get away with passing on, and what does my business look like? And if that comes out in a and that scenario manifests itself in a aggressive way, the question is going to be, okay, how do I rejig the supply chains and the like? And the other key point there is also, it is not overnight. So just pulling permits takes 6 months. To create a new factory is another 2 years. So you cannot just immediately turn on, and just start manufacturing or making at any new destination. So there is a lead time, and that's the obtuse scenario that we talk about, is if that volatility, where we started this whole discussion, if that prolonged uncertainty continues, what does it do to all the investment flows, all the the liquidity flows, and who tightens their belt, and what happens to risk premiums on investing in whichever part of the world?
Your point about it takes ages to get factories built. And one of the interesting things in Europe, we hear a lot about the defense spending that's going to take place. But in Europe, about 50% of military expenditure comes from outside. So actually the impact to the real economy is tiny. And now you're hearing about the European Commission saying, well, look, Europe needs to try and manufacture and create this at home. That doesn't happen in a year. It doesn't happen in 5 years. It typically happens in 10, 15 years, especially for stuff like fighter jets. So we, I think, have to be aware that, look, there's a lot, and we want to think about what the new trends are going to be, but we also need to be realistic that this is a multi-year process. To your point, we can't think about right now. This is really questions around what's happening in the next 5, 10, 15 years.
So I've got to say, we have a very engaged audience. Love it when people are paying attention and submitting questions, which you still can do. A question toss-up for the group. What lessons can leaders of non-financial companies learn from capital markets methods of navigating volatility in periods of uncertainty?
Mm-hmm. I'd take a crack at that. We spend a lot of time thinking about risk management, but never trying to predict the exact outcome of foreshadowing the events that might impact our business. So scenario analysis, which would involve shocking our balance sheet, running sensitivity analysis, prepared for wild swings in markets, And whether that's equity prices trading down materially, volatility spiking, volumes being 3 times, 5 times higher than a historical average, I think corporate companies can battle test their balance sheets the same way. I think generally market participants, corporate C-suites are bad at predicting the future, but you can predict wild swings in market and make sure you can sustain and survive those periods.
I would just echo, I think most corporate leaders are good at knowing where they want to be at some point within a range. But it's a little bit like having a compass, right? You can't just navigate with a compass because there's a lot of stuff that happens between here and there that you can't anticipate. And so you need Waze or something like that to help you navigate to where you generally want to be. And so I agree with you. There's a ton of things that we do where we're constantly looking in the tails to see what are the things that could happen that derail us on our way there. How do we make sure that we have enough wherewithal to get to that place if it takes longer? So this is one of the reasons why we're seeing post-COVID, everybody's so well-financed. Well, nobody saw COVID, and everybody learned I better have more money than I thought I would because the place where I thought I was getting all that money can shut off in a moment. By the way, that's why I think we're better at dealing with the tariff thing. Arguably, if I'm sitting, again, in the administration's shoes, I'm thinking to myself, what better time to actually try to reorder trade than now, right? Because there isn't something exogenous happening in the global economy. And people say, oh, it's self-inflicted. I'm like, well, actually, that would be the time to try to do that if you thought that's where you wanted to go. And so corporate leaders probably have to do the same thing. Like, now would be the time to make some of those bold steps to get where you want to go, but always make sure you have enough financed and that you've looked at the downside, the 1, 2, 3 things that if that happened would materially change you in an adverse way. That's what you kind of need to do. I think that's what we do in the financials.
There are also a couple of nuances in the sense that, so banks, financial institutions, we look at stress loss and look at the tail risk and model every scenario. But what's interesting is what boardrooms and corporates are looking at now. So if you take oil, it looks like $50 oil is almost like an inflation management lever, where that $50 or thereabouts oil price is a inflation dampening tool. So a lot of companies are looking at, when I look at my energy price, because energy is a big input in most production, do I need to hedge or, is it kind of lower for longer? And then the same thing with the dollar weakness. Is this my time to lock into kind of, the dollar rates? Because, this is after a long time, you're seeing that kind of dollar weakness kind of linger for a while. Then the other question is, are rates going to be higher for longer? Because, and we talked a bit about it on the adjacency. So if you look at that, U.S. debt, you got 30 trillion or thereabouts, government and corporate debt, and a third of that is held overseas. To your point around, U.S. assets. So you have on that roster, you have, Japan, China, the UK, and a whole bunch of nations holding a big chunk of that debt. And the question is also, as that debt, clearly, Jim, your point around, nobody's selling, there's no kind of, there's no dumping and the like. There's no evidence of that. But you also see gold is kind of lingering around, 3,500. So somebody kind of flipping and reallocating portfolios. And the question is, if a lot of the traditional buyers, because they're offended, upset, stop buying U.S. debt the way they used to, what happens to the long bond and what happens to the yield curve? Because to sell it going forward, you have to pay up. So the question is, do yields stay higher for longer? So there are a whole bunch of kind of, moving parts, which once again, with a bit of prudence, the key is to maintain, liquidity is, you have to maintain liquidity. We've seen this story before. And when liquidity dries up, then folks start selling the good stuff because that is what is saleable and, to make up for losses on the bad stuff. So I think we're advising clients, stay liquid, be very, very prudent, capital structure clean. Incredible opportunities will come up because when there's corrections, when, it's a great chance to buy and acquire. But there's a lot of prudence that is, the mood right now.
I mean, I agree. I think that's really important for large corporates. If you're a small business, you're in a completely different situation. And if anything, if you've been watching the capital market, you're going to be really annoyed because you've you've seen the market drop, you've seen a lot of volatility, all these crazy headlines. You've maybe decided to cut expenses, you've maybe started to think about job losses, and then 2 weeks later you've recovered. So this environment, we sit here at Milken, large corporates, everyone's doing really well, but if you're a small business, this has been a really tough time. And the administration, this is a good time to do it in a way, but I don't know if there's ever a really good time to create that much disruption when small businesses account for 80% of your employment.
You're 100% right. And so this is I'm just saying, if you believe you need to change it, now would probably be an okay time to do it. But yes, if you're running a small business, and I have a lot of friends who do, I came from one myself. My father is super thankful not to be running his small business because you feel helpless in terms of your ability to navigate. And so again, this is one of these things. Make sure you're well financed. Make sure that you have staying power. These are pretty basic, survival skills, and now would be a good time to exercise those.
I have an insanely optimistic comment in here, too, that I would love for you guys to weigh in on, because it is the most optimistic question I've seen so far. As uncertainty and volatility goes up and growth is expected to go down, do you still think that the potential trade deal or tax cut could push the market to another all-time high by the end of the year?
Sure. I think the thing we haven't really gotten to today, and time probably won't allow for it, is just the pace of innovation and change brought about by technology. And so against what has been a tough equity tape, against what has been a lot of uncertainty, which we covered well, the acceleration of change brought about by AI, machine learning, and computing power is exceptionally high at the moment. My own company, Citadel Securities, is a beneficiary of that. I'll remind the group, and many of you are familiar with these statistics, we trade close to 25% of daily U.S. equity volumes, and we have 1,700 people in total. The operational scale and efficiency that a modern market maker can create leveraging technology is really an amazing thing. And we continue to get better and better and better at that as computing power and machine learning gets more innovative and broadens its ability for us to leverage the market flows that we execute every day. That's specific to us, but that's playing out with every corporate around the globe right now. And it makes us wildly optimistic about the future, including for equity market valuations.
Can I a slightly different take on that? So I think anything is possible. And it's interesting that yesterday there was someone, I can't remember which house it was, that said a forecast for S&P 500 of hitting 7,000 this year. And then equally today, Tudor saying that actually it's going to come to, I think it's going to drop to somewhere around 4,000. So complete array of forecasts out there. It is possible. It is not my baseline scenario. I think there's going to be, the market is going to end up higher this year, but only modestly. But one way of getting a really big move up is if you get a big clean out in the near term. You get a big clean out, people are waiting for valuations. Everyone here is looking for opportunities. So I think that's one way of getting a new high, is a big low first.
My advice to the person who asked that question, don't put a time frame on it.
Yeah.
Everyone's so bound by what's it going to do this year. Honestly, do you need the money this year? Right? I guess if you do, then I guess you're worried about what's going to happen to asset prices this year. But if you don't, the question is whether or not equity prices are going to be higher in 3 years or 5 years, and where are they going to likely be? And if you were to ask this panel, we probably have a higher degree of conviction around that than we do about whether or not the S&P 500 is going to be higher this year. I have no idea. I guess I could probabilize it, but it wouldn't necessarily tell me whether or not it won't be actionable. I don't know what to do with that.
Assuming that 2025 is a barometer of how things are going. So
yeah, it's too new. Again, I go back to what I said before, New World Order. Mm-hmm. It's a New World Order. We all of us have benefited from the rollback of interest rates from 1980 to 2020 to zero twice. Very few people know what it's like to invest in a market where you have double-digit unemployment and double-digit inflation. That was investing from 1975 to 1980, 81. All right? We don't even know what that looks like. I remember it. I wasn't investing. It wasn't a very happy time. By the way, that was the United States. I'll take your point, right? The United States has had difficult times during the last 100 years and still came out on top. So again, if you have staying power, your best bet is to be able to hold these things, whether it's your investment portfolio or your business, through the cycle and be able to withstand the volatility. If you can, you're going to win in the long run. That's kind of the way I would think about it.
Do you have confidence, Umar, in the U.S. equity market this year and in the U.S. Treasury?
Look, equity investor, so eternal optimist. So the answer is yes. I mean, even in my career, and many people in this room, I'm sure we have seen true dislocation. I mean, when I started, I was literally on Wall Street for 9/11. We've been through the GFC. We've been through COVID. And look at us now. It just continues. The innovation, the opening of the markets, new participants, new ideas. So yes, to answer the question, that was, as long as you don't need the money, of course, yes, I'm very, very positive, and I would take the bet.
Can I just make an observation? I mean, we've got 3 minutes left, so it could still come. But this is the 7th time I've spoken at Milken, and this is the first panel that we haven't mentioned the Federal Reserve.
I thought about it, I'll be honest.
But I think to me it's telling, right, that the structural changes that you potentially could be seeing and what the administration is doing has left Federal Reserve kind of in the dust. I don't know how important it is anymore to drive in market.
Say ahead of Fed Day.
I know, and I'm with you, I think, tomorrow on Bloomberg, so don't mention this.
Well, but so I think they're in a bit of a pickle, right? I don't know. I mean, again, we still see inflation, and the jobs market seems to be pretty resilient. We'll see what happens with whether or not the job cuts are structural or whether or not they're just, I would say around the edges. But I think the Fed is actually trying to keep its hand pretty steady because what it can't have happen, we cannot have a rise in inflation. And they all know what happened in the 70s when they took their foot off the gas and it reemerged. And that's the one thing that the Fed can't really control is rampant inflation, and it would destroy asset values in a very meaningful way. And so they got to be, notwithstanding what the president would like them to do, they're going to be higher longer, and they'll be slower until they actually see the recession with the whites of their eyes. That's my view. Right, and that's maybe we could talk about that, but I don't think that's the thing that we should be hanging our hats on, even though maybe the next 24 hours we will.
Well, it certainly is Fed Day tomorrow, but the point you're making, final question, I'm going to pass it to Jim, because right after we saw the 90-day tariff rollback on the wake of Liberation Day as well, we talked to your team over at Citadel Securities. They were kind of the first to give me their inflation forecast. It was higher, to say the least. But is it the Fed? Is it the worries about a slowdown? Or is it the fiscal situation that's going to be leading the market in the next few months?
Look, I've respected, and I think it was long overdue, the fiscal debate and discussion that started between market participants, the new administration in Washington, and I think policymakers. And so for America to continue to thrive, it's got to get its fiscal house in order. There is a lot of debt that has to get rolled daily, weekly, monthly. At higher interest rates, it's obviously that much more expensive. I mentioned earlier, we haven't seen non-U.S. investors selling of U.S. Treasuries, but the fact that we're even discussing that, it's not yet a fragile situation, but it's probably the most important policy consideration over the next decade. Hopefully it's the one thing that both sides of the aisle can start to coalesce and agree on. And I think it's possible to make progress. It's hard, but it's time. And I think just the start of this discussion has been incredibly healthy.
Well, we thank you all for your time. I've got to say, I'm going to be using the word trust deficit for the next year. Are we still holding on to it? We thank you all for joining us today and thinking through the long term and, of course, in what's been a day-to-day market. And nice to see all of you today as well. Thank you.